Yeah, we're going to talk about a few different options from the banking side of things. I think they hand out a pamphlet that we kind of put together for most SBA kind of requests. There are two primary SBA programs. One is a 7A loan and one is a 504 loan. 7A loan is more for your business assets kind of dealings. If you're going to consolidate debt, maybe if you're buying a business, that'd be a good 7A opportunity. Any kind of inventory or receivable financing that might be kind of out of the typical realm would be a 7A opportunity. The reason for that is, there might just be some kind of wrinkle with the deal with the loan. Either they're short on collateral or just maybe you're trying to stretch out inventory for 5 years, particularly banks want to keep that under 12 months. So the reason why banks like it or would prefer to do it is because the SBA, the government, comes in and says, well, we'll guarantee 75% of this loan. And so that gives us an incentive to say, well, yeah, we will finance this out of our typical credit policy world. Again, a good example is if you're buying a business and you're paying $100,000 for it. Really, there's only $50,000 of assets involved. Well, there's $50,000 of what we call blue sky, an intangible value to it. So to us, well, we're a shortfall in collateral. Maybe the buyer doesn't have a down payment to make up that difference. So we would pursue an SBA guaranteed loan just to kind of mitigate that risk of lack of collateral and protect ourselves. Another example is if you have say a line of credit maxed out and you just don't have the opportunity to pay it down. You have other debt to the side too. The SBA 7A program is a good opportunity to consolidate all that debt. And then you might be commingling different assets and collateral, some equipment that has a 5-year lifespan. Then you have receivables that really aren't that valuable over 60 days. So the bank might say, hey, we'll give you a 7-year note if we get an SBA guarantee. And so it just protects the borrower because it helps out cash flow wise. It makes things that might not fit in the typical world work better. I will say with the SBA 7A program, it's not something that you can get done in 30 days. It's definitely something you're going to need 60 and 90 days heads up because you're working with the government and there is a pile of paperwork you have to go through to get it. And it's worth a while because you do get what you need, but it's a slow process, just getting everything to that point. Another SBA program is a 504 loan program, and this is a much easier and much more beneficial to the borrower, if anything, because it's for if you're buying real estate. And use an example, if you're buying $1 million property, and typically banks want 20 to 25% down, well, that's up to $250,000. And you say, I don't have that. With the SBA 504 loan, you can go into it with as little as 10% down. I sound like a car dealership right now, but it really is. You can come in with 10% down, and then the bank will loan you 50% of that purchase price. And then the SBA will take a side note at 40%, and then you bring the 10% down. And the reason why this is really been, especially right now, is beneficial because the SBA loan, in this example, would be $400,000. You can get a 20 to 25 year fixed rate on that one loan. And today that rate's 2.5%. So it's real cheap money. It's long-term fixed money. Whereas the bank will probably do a 5-year fixed rate, somewhere close to 5% on that range. And then you're going to reset 5 years at what the market rates are. So it's a great program because one, you do get to go into it with a low down payment. And two, you get an extremely low interest rate that is fixed. And that's a much easier process. That's a loan that really we work with a third party on the SBA loan, and their paperwork is it's much cleaner, quicker. I recently did one and we did close within 30 days because it's just not as tedious work. frankly, probably because it's much easier because usually it's real estate involved. So that's just easier to underwrite from the SBA point of view. Now, we talked about buying real estate with that. You can also look at refinancing debt through a 504 loan where you take out your current loan and then you do the separation like we talked about, where the bank will take you typically a larger sum, probably 60% in that example, and then you have the 40% SBA loan, again with that fixed rate, long-term fixed rate, just more flexibility in that side. Also, the 504 program does offer equipment purchases for the same thing. This is if you're buying, a good example is if you're buying a crane, something like that, a big ticket item, and you can go out and get a 504 loan, same structure where you put down 10%. And typically now equipment, you'd only stretch it out 10 years, but still you're getting a 10-year fixed rate. Today's rates are in the mid twos on the SBA side, and the bank still will be that 4 to 5% range on it. So, from a bank point of view, we jump at the opportunities of 504 loans because it's just not as much headache for us. But we are also very open. Any bank's open to do an SBA 7A loan because we're only, SBA is guaranteeing 75% of it, and typically we're the borrowers benefiting from stretching out cash flows from maybe a loan that has 2 years to pay off to 7 to 10 years. And it can really clean up a balance sheet through a 7A loan by consolidating everything, and then you're kind of starting over again. Another good example is if you set a line of credit, you can take that line of credit balance, put it on a 7A loan, stretch it out 7 years, and ideally you would clear up your line of credit to availability and start back from zero, and you can start using that as needed. Again, though, 7A, there is a lot of work, and they are going to make you pledge every kind of asset you have for collateral, including your house. They typically do take a second on your house. So, but again, in the long run, it is beneficial, and that's a long-term loan that maybe you won't be able to get in that world. In that handout, there are a few other SBA programs out there that aren't as, I say popular, but they are things that we can do or banks can do. Probably one that might be of notice is it is an export loan. There are smaller SBA loans. Say if you only go up to, I think, $150,000. There are kind of express loan deals where there's not as much paperwork involved and there's a quicker turnaround. And frankly, there's less fees because the SBA is going typically guarantee 50% of express loans, not 75%. So there's other opportunities in the SBA world. I will quickly talk about the PPP loans that maybe some people have got over the last couple months and are scratching their heads right now what to do because their 8-week period or they've used all the money on whatever they're supposed to on those loans. Typically those loans were first started saying, hey, this money is for payroll plus operating expenses. Payroll is pretty clear cut. It's your wages. I think it includes benefits and things like that. Whereas the operating expenses, very much gray on what it was. They said rent, they said utilities, things like that. And then there was a lot of questions on that. Well, yeah, they came back out and said, hey, we're going you guys have 8 weeks to use it. Now we're going to give you 24 weeks to use all this money. And what I've been telling people is don't even look at forgiveness until you've used all that money on payroll. That way you take out that variable from the operating expense side that we don't quite know what's included in that bucket. If you can go show, hey, I used all my money on payroll, it's literally called payroll protection program, why wouldn't I not be forgiven? That'd be the best way to go. Having said that, banks have no way to process these loans yet, these forgiveness side things. We have got no guidance on it. There's a lot of people I've talked to who've already used all their money on payroll and send me applications, and I say, well, we can't accept this because we don't know how to process it yet. The SBA is kind of dragging their feet on it. And it sounds like the reason they're dragging their feet is we're expecting maybe for them to come out and say, hey, if you're under this threshold, if your loan's under this amount, we're just going to wipe it clean and forgive you. Who knows if that's going to happen? I've heard anybody under 150,000, you're done, no paperwork needed. And I heard up to 500,000, no paperwork needed, you're forgiven. I do think they're going to do something. I just don't know what dollar amount. They see the headache that it is on customer side. The headache's going to be on the bank side, and then the massive headache is going to be on the SBA side, trying to process all these the forgiveness things. So sit tight on the forgiveness on any of those kind of things you're looking at. Just kind of keep your ear to the ground, because when Congress comes back, I know that's going to be a big priority, is how are we going to handle these PPP loans and the forgiveness side of things, because nobody knows how to do it yet, and we're all just kind of sitting and waiting. So kind of probably went through that pretty quickly. I don't know if there's any questions or anything else anybody want to talk about.
Cody, I have one question on the EIDL loans, I guess, where a lot of the small businesses got $5,000 and $10,000. Are those also forgivable, or is that still up in the air also?
I think that's kind of up in the air, and those came out at the same time the PPP loans came out, and the EIDL loans were strictly, those were straight through the SBA. You would go online and apply through the SBA for those loans. And when it first started, I think it was you get $1,000 for every employee, and it was a grant. Well, that was probably mid-March, and I'm just now hearing people getting their money today. And I think between now and then, it's changed a lot. It has gone, depending on the amount you got, I think it's pretty much gone from a grant to maybe a long-term loan. I've heard the world, and we haven't done with the PPP loan. I think it's pretty much a long-term loan, 30 years. The SBA worries and getting answers right now on it.
You guys have any other questions?
I don't know if you can hear, but
I can.
I'm curious what third-party SBA vendor they use.
The question, Cody, I don't know if you can hear it, is what third-party SBA lender that you guys use at the bank?
On the 504 loans, what third party do we use? Was that the question?
7A.
Oh, 7A. 7A, it's all in-house. The only third party we might use is to package everything that's needed, because it's literally piles high, I mean feet high of paperwork needed. So we do have, they're simply called packagers that we work with, and they represent you. They'll meet with you and say, hey, here's all the different forms the SBA needs signed, and then here's all the documents the SBA needs. It's frankly, banks love 7A. Like I said, we do have that 75% guarantee, and there's times we have to try to collect on that, and that can be a very painful process, because the SBA goes through every single document to make sure we have all of our T's crossed and I's dotted. So that's why we bring in the third-party packager, because they kind of take care of that for us and make sure that we're good, you're good. It also helps when we go and submit our application to the SBA for approval. They know what the SBA wants and sees, and so that kind of helps make sure that we will get that approved. And kind of to touch on the approval process from the SBA side, we do submit this packet to them. There's two different ways that banks do it. We submit it and let them just be the lead on it, and they go through it and say yay or nay. Banks also are PLP lenders, preferred lenders, and that would mean that the bank kind of already has a rubber stamp for approval, and then we just submit it and they just kind of sign off on it. So if it's something that we feel confident in, majority of the time we will go the PLP route, which helps speed things up on that side of things. Now with the 504 loan, I did mention a third party we go through. Some of the local ones is Heartland Business Capital. There's another one called RMI, and they are just, they're called CDCs, and they work directly with the SBA, and they actually keep the loan on their books, but they are an SBA affiliate company.
Does that answer your question? Okay, awesome. All right. Anything else for Cody? All right, well, hang tight. We may have more questions, but all right. So our presentation today, we really wanted to talk about traditional types of financing and then some of the more untraditional types of financing, and that's kind of where I come in. So I do financing for small businesses, and a lot of this, I don't know, maybe, what I hear often is that the clients that we work with, they're like, I didn't even know this existed. How did I not know this was an option? So I'm going to talk about 3 different types today. And the first one is accounts receivable factoring. And I'm just curious, has anyone heard of factoring? Even know what that is? Okay. Well, when I tell people that, I get that deer in the headlights all the time. They're like, what did you say? Factoring, isn't that like a math thing that they learned in high school? But anyway, so factoring is basically you're selling an asset, you're selling your accounts receivable to a finance company at a little bit of a discount. It's exactly the same concept as if you're a small business owner and you sell, you give your customer maybe a 2% discount for a quick pay. You've heard of like a 2% for a net 10. It's that exact same concept. So basically, a factoring company will come in and they will buy that receivable at a little bit of a discount. And the whole idea is kind of like this little cartoon. A lot of our clients, they have money on their balance sheet and receivables, but it's not in the bank yet. So they're trying to push those two together. So, and I'll just give a little plug. So throughout my little presentation, I've got these little cartoons from Ted Goff. He's a local Kansas City guy. I don't know if you guys knew this, but he does a lot of, I think, and I'm a finance nerd, so I think these are funny. But anyway, you guys can choose yourself if you think they're funny or not. But I buy a bunch of cartoons from him and just kind of recycle them for different presentations. But anyway, super cool guy, and he's a local guy here in Kansas City. So anyway, so kind of, with Cody, what he was talking about, the financing options that we're going to talk about, they're a little bit faster, they get done quicker, but with that also comes they're more expensive. So if you can get an SBA loan and you have that time to do that, as a small business owner, I would always suggest that you do that. These are options that might be available for startup companies and other businesses that need that money sooner rather than later. And a lot of these options can be a short-term bridge, maybe until you can get some long-term financing in place. So just kind of know that. So kind of looking at this, so with factoring, we are 100% different than a traditional loan. So if you have financing in your background, you have to almost take that hat off and think of it as a whole different way. So, when you go to the bank to get a loan, they're giving you a loan based on some kind of collateral, maybe accounts receivable, and maybe inventory or equipment or ideally real estate. So we're actually not getting a loan against anything. It's a purchase of an asset. So with the bank, you're going to be charged an interest rate, like he mentioned, 2.75, which is awesome, so cheap. So with factoring, you're giving up a discount. So, again, if your profit margin is 30%, you might be giving up 2 or 3% of your margin to get that receivable money right away. The biggest issue, too, why factoring companies can often provide financing when banks can't, is 90% of the approval process is based on the strength of the receivable, not the business owner. So again, as a startup company, you can qualify for factoring if you have good customers. They don't all have to be Walmarts. They just have to have, what a factoring company does is we'll typically run credit on their customer, and we make our approval based on the strength of that customer. We do look at the business owner in general, just to make sure that, they're not, they haven't opened 5 businesses and bankrupt 5 businesses. We want to make sure they at least kind of know what they're doing. But then most of the thing, because what we're doing is actually buying that asset. So we want to make sure that if we buy that receivable, that customer is creditworthy and strong and ultimately going to pay that, although it might be net 30 or net 60. The other thing, too, is as compared to a bank, like a bank will give you a line of credit, let's just say $100,000 against some kind of asset. With factoring, as those receivables grow, your line of credit per se just keeps increasing. So if this month your receivables are $50,000, but next month you're grown and you're 75 and 80, you'll typically always get about 80 to 90% of what your receivables are. And so that's what's really great about using those for startup companies, because again, as they grow, they're going to keep getting have the availability to have additional capital based 100% on their receivables. Also, one of the things that I kind of like about it is, again, there's not a monthly payment, like again with the bank. So if you sell this receivable to a factoring company, when your customer pays that, it's paid and you're done. And so you're not having to make a payment to the bank every month for that line of credit that you're using. With this, though, there's pros and cons. So the benefits, obviously, is we can use it for a startup company. We see it mostly in businesses from startup to their first 1 to 5 years of business, so they're still pretty new. And they're just not quite there yet for that line of credit at the bank. Maybe they've got 2 years under their belt and they really need 3 years of financials, something like that. So for startups and newer businesses, again, because the credit is really based on the receivable. If the business owner does not have good credit, that's not going to disqualify them. If they have a bankruptcies or judgments or any of those kinds of things, again, we're kind of looking through the business to see who that receivable is with. And so if there are some personal credit issues, they can still get approved for that. And then also, one of the benefits is if you're thinking about working with a new company and you don't know much about them, the factoring company will run credit on that customer before you sign that contract with them, and we'll let you know that yes, we can fund that, or no, they don't have the best credit, they're paying other vendors very, very slow, and it gives you some data before you kind of start into a new contract with somebody. And I kind of call it helps with growing pains. So again, going back to those newer businesses where they're doing okay and they have the opportunity to take on more work, but they're just not sure they can do it because then they have to hire another person and, does it make sense and all that kind of stuff. So with those types of growing pains, sometimes factoring really does make sense. Because if you think about it, let's say you're a newer business and you've got, a good book of business and you've got the opportunity to take on a new job. So like we work with, let's say like a janitorial company. And they'll go in and clean, let's just say they clean the chamber. So they come in at night, they clean the chamber every night after work. And then what would happen is they would clean the building for the whole month. At the end of the month, they would invoice, and then they would wait sometimes another 30 days for them to actually write the check. So from day one to that first check could be ideally 60 days. And if you've had to hire a new person to take on this account for you, you're covering that payroll for 60 days before you even get your first check. And so that's where factoring could potentially help, because as you invoice, you're getting that money right away to help keep 90% of the time it's payroll driven. As they invoice, they're getting the majority of that money so that they can keep going with their payroll. Another positive is because you do have now more cash, if you're needing to buy products or supplies, you can now take advantage of some supplier discounts from the vendor side because you have the cash. Maybe you can get a 2% discount when you're buying your cleaning supplies or things like that because you do have more cash on hand. And then one of the other benefits is the factoring company, traditionally, most of them will help out with collections. So again, if you're a small janitorial company and you've got, let's just say, the wife in the office helping out, making some past due calls, following up on that. The factoring company, they act like your back office, and they do help out with those calls. They'll just follow up. And a lot of times, small businesses will oh my gosh, that was a whole benefit I didn't even know about because I don't have to deal with those past due calls. And then there's kind of a little bit of a separation too, because if you're the person actually doing the work and then you're having to hound your customer, that maybe isn't the right way, but for payment, it kind of gives you a separation, and it's almost like you've outsourced that back office piece of it to help out with that. The cons, though, unfortunately, is it can get expensive. if your customers really are paying you net 60 or net 90, it can get expensive. It works really well for those customers that you're working with that typically pay in a 30 to 45 day window because the fees aren't that much, and it does really help kind of turn that cash flow. If it goes out 60 or 90 days, it can be expensive. Another downside, if you're in an industry where your profit margin truly is 3 to 5%, it may not make sense because you're at such a tight margin anyway. To give up 2% on 4%, it just doesn't always make sense. I'll go through an example about how it might make sense, but in general, if your business is going well and you're not really in a big growth mode and your margins are pretty tight, it may not make sense. So the collateral that's used, collateral for this type of financing, is the accounts receivable. So if you do have other business loans where your accounts receivable is pledged for collateral, that could be an issue because the factoring company, since they're technically buying that asset, they would need to have a first position in that accounts receivable. So I'm going to go through now that little handout that had like kind of the factoring costs versus growth. So this is where we see that it makes the most sense in my world is if you go to that example, you'll see a company that maybe had revenues of 100,000. That's kind of where they were sticking at. They really want to grow, but they just can't get there yet. So they have a cost of goods. We'll go back to a janitorial, which probably these numbers don't make a lot of sense, but let's just say that their cost of goods for equipment and supplies to run that janitorial company was 60%. So they're at a 40% profit margin. They've got their own building, they've got some overhead, things like that. So without factoring, you can see that the net profit there is $2,000, which basically is 2%. So they're very, very tight. In general, if that company could not grow by taking on more work, then we would say don't do factoring. But let's say they have the opportunity to pick up 6 Applebee's to start cleaning, and they can actually take on more work. They have to hire maybe 1 or 2 people to do that, but they can significantly increase their revenue. So again, I'm just doing easy numbers because it's simple. Let's say they could actually double the revenue because they have some new contracts coming up. Their cost of goods is going to stay the same. Gross profit's going to stay at 40%. I did increase their overhead because they're going to have to hire a couple people to do that work. But you can see, even if they're having to pay 4% for that factoring, and again, that 4% is based on the invoiced amount or the revenue. So that's how that's calculated. They actually are able to increase their net profit, and they've increased their profit margin also, even taking into account the cost of factoring, because they're able to take on more work. And I would say, without a doubt, factoring works for smaller, newer businesses that are in a growth mode. If you're where sometimes if you ever hear about factoring, you may hear of it in a bad connotation. If it's a business that's been around for several years, and to be honest, they're just not quite making it, their margins aren't there, they're kind of not doing well, and then they try to do factoring on top of it just to keep up, and it doesn't make sense because that could ultimately hurt them because they're giving up even more of their profit margin and they're not taking on additional growth. So I hope that kind of helps better understand it. So I'll give you one more example of kind of what it means. Like if you think about retail businesses, they're constantly doing credit cards. So, as they sell things, they're processing it through a credit card. The credit card company is giving them that money right away, but they're taking a little bit of a fee. It's exactly the same concept with factoring. So instead of running it through a credit card company, you would run it through a factoring company. They would give you the majority of that money right away and then take a fee out of the back end of it. So typically fees range anywhere from, I would say, 2 to 4, sometimes 5%, depending on if they go out 60 to 90 days. So on average, I would say close to about 3% is the fee that you would be giving up if you decide, factoring might be an option for you or a business that you know. So, you have to make sure that makes sense and that you can grow with that fee going out, that hitting your bottom line. And again, one thing I really like people to know is that factoring, again, is based on the receivable, so it's not an interest rate. So kind of going back to, if you have $1,000 invoice, your fee is 3%, that's going to cost you $30. So it's not an interest rate, it's just a flat fee off the face value of the invoice. What factoring is not, and we get this call a lot where they just want to sell me all their old invoices, all their bad debt. That's not what factoring is. They're like, oh, I've got these invoices. I could see this a lot in construction where they've got that 10% retainage and they want to sell me all their retainage. We just can't do that. So typically the receivables that would be purchased by us or any other factoring company are anything in that 30 to 60 day aging. If they go past 90 or 180 days, that's not really a good receivable for us to purchase. So does anyone have any questions on factoring and kind of how that works? We find, again, payroll's the biggest issue. It works really well with, right now we're seeing a huge, because of COVID and everything, we work with a lot of medical staffing, nurse staffing, where they're having to provide nurses to hospitals, nursing homes, those kinds of facilities. And so the companies, our clients, are providing the staff. They're having to pay those nurses every week. A lot of them are having to pay exceptionally high wages because they're in we have clients all over, but we have some that are in New York. I mean, some of those hourly rates are up to $100 an hour for an RN. And that small business is struggling trying to cover those hours. And so basically every week they'll invoice the facility, and then every week we give them that money for payroll. Otherwise, they would have to go 30, 40, 60 days before they get paid. And they just can't, small businesses just can't do that. So we work with lots of staffing agencies. We work with a lot of janitorial, again, because they'll clean all month, then invoice and wait another 30, 60 days. And with current conditions in COVID, we're seeing tons of our janitorial clients super busy, cleaning a lot of Amazon distribution centers, all of those kinds of things. And then the other thing that we see a lot of right now is security guards. So again, it's kind of the same thing with the payroll. Our security companies are having to work round the clock to deal with some of the craziness that's been going around, to keep businesses and a lot of commercial spaces safe overnight hours while there was the writing and things like that going on. So those are some industries. It's just payroll. That's the biggest issue, is they're trying to make sure they always have enough money to cover their payroll. So the next type of financing I want to talk about is called purchase order funding. And that's kind of one step back from factoring. So the difference here is, with an invoice, you've already done the work, you've provided the service, the product, and you've invoiced it. Now with the purchase order, this is where a small business may actually need the money even to fulfill the order. So I kind of, gave an example, like let's say you've got a small business here that has the opportunity to buy some Chiefs sweatshirts and sell them to Rally House. And they can get a great deal on these Chiefs sweatshirts, but whoever they're purchasing them from, they have to put so much money down, and then the rest of the money has to be paid before it's even shipped. So ultimately, they're having to pay for all that product before they can even deliver it to Rally House and invoice. So with factoring, as soon as they delivered that and Rally House received it, we could factor that invoice and give them that money. But in this case, they actually have to put 50% down when the order is placed, and then the rest of it must be paid when it's ultimately shipped. And so, a lot of small businesses couldn't take that opportunity for that order if they didn't have some purchase order financing in place. So it kind of goes back one more step if you needed actually to fulfill the order. And we see this a lot, and there'll be a small business will be buying something. Let me try to think of an example. A lot of it is with apparel, where they're bringing stuff in from China. We also had a company that was selling high-end medical equipment. It was mammogram machines and huge invoices. And before that equipment would ship, he had to put 50% down, and it would ship to the hospital. And at that point, he could invoice. And these were, $200,000 pieces of equipment, if not more, and he couldn't come up with the 50% down. But he had awesome margins. So if he could just get the money, he could then turn around and invoice it and make, 30, 40% profit, which was fabulous. So in that situation, he worked with us, I think, on the first 3 or 4 orders, and then he had enough cash flow to kind of keep him going at that point. But So kind of what's a little bit different is like who qualifies for this type of financing. It's usually wholesalers, distributors, people importing again from China and then reselling it. It's ideal for businesses that are just in that distribution where they buy something, turn around, resell it, and earn a nice profit margin on that. That is the perfect example of where purchase order funding would come in. Now, where it gets a little hazy or an issue is I get calls where people want to buy raw materials, construct it, and then sell it. And it can be done, but it's not ideal because think about that. If I give you $50,000 to buy the raw materials and heaven forbid you don't make it right or there's a mess up in the batch or something and all that money is gone because now you can't resell it. So again, if it's just bring it in, put your stamp on it, your logo or whatever, that's perfect. So, and then we also get calls for construction where they bringing in that, they're going to construct, build something and then turn around and sell it. And so I would say traditionally not with construction, or I call it if you have your hands in the mix too much, as a small business owner, then it becomes a little messier. So ideally, just if you're going to bring it in, put your stamp on it and sell it again, that would be great. It also would not work if you truly are a startup because, again, you don't have the track record for doing what you're doing. And so it makes it a little more challenging for a purchase order transaction at that point because you just don't have the experience behind you to even do the part that we would be looking for you to do. So the biggest benefits, without a doubt, is it just helps small businesses take on bigger orders that they otherwise wouldn't be able to complete. So that just makes sense. So if you get the opportunity to do something, but you need to put money down on it, and there's no way you have that money down, then this is a great option in that certain kind of situation. Also, a lot of times you can get favorable terms with that vendor because you do have a third-party finance company behind you. So maybe they'll give you a little bit of a discount because, again, you're paying for cash up front potentially. So that can kind of help too. And then, what happens if you're a small business and one of your biggest customers comes to you with an order and there's just no way you can do that? So it eliminates the threat of maybe losing some of your potential customers by not being able to fulfill those orders as those come in. And I didn't really talk about this, but I'll mention it here in the purchase order side. So with factoring and also purchase order financing, you guys think about Shark Tank. You see those people come in on the show and they're all ready to give up 5, 10, 15% of their business to have somebody come in and help them with a new order or a new product or something like that, which sounds awesome. But in reality, me personally, I don't ever want to give up any percentage of my business. I don't want to give up any of my equity. And so there are companies out there that will give you money and help you with this kind of stuff, but they want a percent equity. And with factoring and purchase order funding, you're never giving up equity. They're giving you money and it's all based on the receivable and the inventory in that product. We've had examples of, companies that have used factoring and purchase order funding and have prevented having to give up equity. And let's say it's 5, 10 years down the road and their business is worth a lot now and they've never had to give up even that 5 to 10%, which could be millions of dollars if it's a very successful business. Does that make sense, kind of what I'm talking about? So I always caution all of my small business folks, and it's so easy when you're new and a startup, you're like, oh, I'll give you 5, 10%. But 10 years down the road, how much is that really costing you? And hopefully, if you are very successful, it could be very expensive. So I always caution about doing that. The drawbacks, obviously, it is more expensive. So in that scenario where we talked about, so you have to start paying fees when they put the money down. And then especially we see this, like if think about this, you're buying product from China, they require 50% down, and sometimes it could take 30 days for that to get shipped over. And as soon as it lands, then they have to pay the rest. So that money is just out longer because then as soon as it's shipped, okay, you put 50% down, it comes over on the water from China, and then you have to pay the rest when it is delivered at the dock. And then it may take another 15 days or whatever to put your stamp on it and do whatever you need to do, and then ultimately invoice it to your customer. So that window of time where that money is out is more. So you're paying for now purchase order funding, and as soon as that product is delivered to your customer, then you actually factor the invoice to pay off the purchase order funding. So you're almost paying twice. Does that make sense? So it is expensive. It could be expensive, depending on how long it takes for all of that to happen and how long the money is out. Because with purchase order factoring, they always factor it on the back end to pay off the PO funding, and then now you're paying factoring on top of that. So margins have to be really good in order to make that sense. I tell people, unless you're at a 30 or 40% margin, I wouldn't even think about PO funding, because you could be giving up 10% easily. Now, if that allows you to take on more work, that might make sense. If it allows you to keep your customer because you've got more orders coming down the pike, that makes sense too. But it can definitely get expensive. And I guess, one of the biggest drawbacks too is if the small business is involved in the assembly, the production, or any of that piece of it, it makes it more challenging to do purchase order funding. And it's not for every business, without a doubt. The best ones for sure are the ones who are just bringing it in, stamping it, and sending it off again. Do you guys have any questions on purchase order funding? No? Okay. So kind of the last one that I'm going to talk about is merchant cash advance loans. Has anyone heard of those? Really? Okay, so that surprises me. This is a hard one for me because I don't like them, but I would consider them very similar to payday loans. So if you truly get a payday loan and you use it the right way, I think it's fabulous. Your car breaks down, you go get a payday loan, you fix your car, when it's payday, you pay your loan off. Perfect, excellent idea. We all know that that's not how people use them. So merchant cash advance loans came out originally. What it was if you were a retail business and you had a lot of credit card sales, like a restaurant, a bar, or something like that. So what they would do, these finance companies would look at the last 6 months of your credit card sales, and they're like, yeah, this company's doing, I don't know, $200,000 in credit card sales. And they would figure out how much of a loan they could provide you. And then so they give you the loan based on your previous sales, assuming that over the next 6 months you're going to have similar sales. And every time you had a credit card sale, every day that you batched out, a certain percentage of that would go to pay back the loan. So that, in my brain, that still makes sense too. And so if you got a merchant cash advance loan based on your credit card sales, that made sense. And so what has happened though over the years, maybe the last 5 years, that they started offering these merchant cash advance loans to businesses that don't have credit card sales. So they tweaked it and they've changed it. So instead of getting 6 months of credit card receipts and sales, like a sales journal from your credit card company, they're getting 6 months of bank statements, and they're trying to figure out what your cash flow is based on your bank statement. And then they're figuring out how much they could potentially loan you, and then doing that. And so then the repayment now becomes a daily debit out of your bank account to repay the loan. So, and I will tell you, the rates are comparable to payday loans. So they're very expensive. Does it make sense? Maybe. If you are in a really tight pinch and you need something, maybe. But it is very expensive. So the kind of, I guess, kind of how it works. Like I've given an example here. So there's an example of a business that they need $50,000. They get one of the, I call it MCA loans, merchant cash advance loans. They get the loan, and the repayment factor is typically, if you take the loan amount, it could be, you multiply that by 1.2 or even up to 1.5. That would be how much you're paying. So in our example, we're going to use 1.3. So if you get a $50,000 loan, your repayment is now $65,000. So you're paying $15,000 in fees, which doesn't sound terrible if you're paying that back over 30 years. Typically, you're paying that back in 6 to 12 months. So that is super expensive. And then, the first example, as you had credit card sales, they'd start yanking, they figure out maybe 10% of your sales is going to go towards to repay that loan. So it could take, 3 months, it could take 6 months, it could take 12 months. So in that scenario, If you have higher credit card sales, again, 10% of your sales is going to go to repay this loan. So you could actually get it paid back sooner versus later, but the positive in that situation is it's always 10%. So if your sales are down 1 month, it's just 10% of those sales, which is kind of a nice piece of that. You're not paying a monthly payment, it's just 10% out of the sales. That being said, there's no prepayment incentive, so you don't get a bonus or a discount if you pay it off in 3 months or if it takes you 12 months. And then the other example was if you don't have the credit card sales, it's just a daily debit out of your bank account, which that's where we see a lot of small businesses really struggle with that, because they get the money and they spend it and they do what they're going to do, and then every day they're getting $200, $300 deducted out of their account to pay that. And after a few months, that gets very expensive, and then if they overdraft, then that causes a ripple effect, onto that. So it kind of becomes a problem. The pros, I guess I would say, is it is about the fastest money you're ever going to get. There are online lenders right now that you can apply and they will put money in your account within 24 hours, which just sounds fabulous, but it is very, very expensive. The other thing is, like, you fill out an online app, it's about 2 pages, and you give them 6 months of your bank statements, and it's fast and it's easy. There's very little documentation, kind of like what Cody was talking about. Nothing like SBA, so it's super fast money. It's that's where I'm going back to, almost like a payday loan. And 100%, I'll say it, if you use it the way it's intended, it's probably okay, even though it's expensive. It is unsecured, obviously, so you don't need to put up any business assets or your home or anything like that. It's 100% unsecured.
How does that affect the medical?
And the cons, I've already mentioned several. It's just super expensive. There's no benefit to paying it off early. And then I think the biggest con is what I call the danger of the debt cycle. So what happens, unfortunately, we see this, is we'll have a small business that gets one of these loans, and it goes well for a month or two, and then they start overdrafting and having issues, so then they go get a second one to help pay the first one. Never a good, and then you kind of get into this vicious cycle. And we had a client, unfortunately, that had 5 of them before we realized what had happened. And they just, let's just say they didn't make it. So it was a rough, So, and what's sad about these lenders is they don't care if you've already have 2 or 3. They'll just keep giving you the money because, again, their rates are so high, they've built in that default rate, which kind of puts them back to the payday loans. So, again, it makes sense if you need quick cash for something and you can ultimately pay it off really quickly, it might make sense, but I would strongly suggest that you really research those before you get too far involved. And the other kind of sad thing about this is there are a lot of very reputable companies offering them. Right now, QuickBooks is hooked up with Fundbox and some other ones like that. That's what these are. So Fundbox is one. There's one called... I can't remember. I should have written them all down. But, they make it seem super simple and easy, but you just have to be careful about what you're really getting yourself involved in. So those were kind of some of the, I didn't mean to end on a downer. I probably should have told you that one first. But anyway, the other 2 options I would say definitely worth looking at if it made sense with your business. And I guess in closing, banks are awesome. You're going to get the best rate ever if you can get typical bank financing. Some of these other options might be a good short-term solution, even maybe for a year with PO funding or factoring, just to kind of get your financials back where they need to be so that you could get some bank financing, or give a small business owner time to repair their personal credits and things like that. And I've just talked to you about 3 different things. I will also tell you, there is a secondary market out there, so we get folks who call and they need contract financing or they need something like this. And typically there's going to be a way to get something like that structured. Ideally, it is going to cost more, but there is, banks are awesome, but unfortunately not everybody will qualify. So there are other options out there. It's just ultimately you're going to pay a little bit more for it. And does it make good business sense? You'd have to kind of run those numbers and see if it does for your specific business. So.